If you take a look at some Bitcoin, some of the software SaaS stocks, the divergence from the NASDAQ, Bitcoin is saying there's a liquidity issue. There is this incipient banking crisis waiting to happen. That's what it's selling us. I mean, I think this is very high probability, because what I'm saying is not that AI takes everyone's job, which I think is a strong argument for people who say, oh, you're full of shit, Arthur. AI is not going to take everybody's job. I'm saying that's not my point. My point is that 10 to 20% of job losses in knowledge work is game over for the banking system because of how much leverage is employed, right? I don't need everyone to lose their job, just a little bit. And then the market goes, oh shit, everyone's going to lose their job, even though that's not the case, right? So right now it's nobody's going to lose their job, you're an idiot, to 5% and 7% unemployment, everybody's going to lose their job. Let's sell everything, right? So it's an overreaction on both ends. It's the overreaction on the rise in unemployment and the narratives around AI, which leads people to move their money out of the small banks into JP Morgan and to dump these stocks. And that's where the Fed has to come in and act.
Bitcoin often reacts to financial stress earlier than traditional markets. While equities and bonds adjust slowly to changes in liquidity, Bitcoin frequently begins moving before the broader system recognizes what is happening. Because of this behavior, some analysts see Bitcoin as more than a speculative asset. In certain moments, it behaves like a signal, reflecting deeper structural changes in the financial system. Arthur Hayes believes Bitcoin's current behavior may already be reflecting a major disruption forming inside the global economy.
Well, Bitcoin at 670,000 or whatever it is right now is definitely factoring in this potential massive, well, I don't think it's potential, this massive deflationary event as, a certain percentage of the knowledge workforce, at least in America, are no longer have a job, and they no longer can be able to service their high debt loads, and they won't be able to consume with the same propensity that they did before all of these AI tools. I don't think the market is recognizing that yet. We're still in the, of course, not 100 people are like, oh no, AI is going to lead to retraining. Okay, well, how many people were retrained after they lost their, job with full lifetime benefits because China was more efficient? How did they retrain? Did they get the same kind of job when they got back in the workforce? I don't think so. I think they got a job. Definitely wasn't as the bennies weren't as good. They weren't making as much money. I mean, these are the people who voted for Trump in 2016 and 2024. Three times, right? This is the cohort that Trump went after. And so obviously this retraining narrative. Yes, you retrained for something, but did you retrain to make the same $250,000 a year salary, or did you retrain to become an Uber driver making $50,000? Right. So again, I don't know what retraining means. I think a lot of the financial analysts are still stuck in this. Oh, there's creative disruption. America's capitalist model will find something for these folks to do, and then they'll rejoin the workforce and continue to spend money like they were. And so that's the narrative right now. And so that until that narrative breaks, we're not really going to see the contagion effect in what I think of the regional banks, the smaller banking outfits that don't have a government guarantee, that have a lot of these consumer loans as a higher percentage of their balance sheet than, say, a JP Morgan or a Citibank. And the Fed's discount window is not set up to accept assets that are essentially worth zero.
The disruption Hayes points to is not just technological innovation, but the speed at which artificial intelligence could affect employment. Previous economic shifts took years or even decades. Manufacturing jobs moved gradually, industries adapted slowly, and workers had time to transition. Artificial intelligence may move much faster, particularly in knowledge-based industries that rely heavily on digital workflows. And in highly leveraged economies, employment stability plays a critical role in maintaining financial stability.
If you look at the progress in terms of these agentic AI models and what they can do, it's insanely exponential. This isn't like China entering the WTO. If you want to offshore a factory, it takes multiple years to do that before you get to the management approval, everybody construct something new, all the things you have to do. But if $20 a month Claude bot or however much it costs can replace, a whole team of back office counting, that's instant. Especially in the United States, where you have an at-will employment market and there's really very little labor protection for people. There are going to be more companies like Block who fire a large swath of their workforce, and they're rewarded by the markets. The stock pumped 20% when he announced that. So the CEOs and management get richer if they fire all their workers and replace them from AI. That's the message from management. And we know management only cares about their compensation. And so they're going to do more of this. And then there'll be this moment where everyone recognizes, oh shit, these reports, yes, they were directionally correct, but unemployment went from 4% to 8%. And then some people start freaking out, and that's when you get the repricing of a lot of these debt instruments down to an assumed value of zero, and how you get a banking crisis.
If a significant portion of the workforce loses income at the same time, the effects spread quickly. Loans stop being serviced, consumer spending falls, and the stress begins appearing on bank balance sheets. This is where Hayes believes the real risk begins to appear, not as a temporary liquidity issue, but as a deeper solvency problem.
The smaller banking outfits that don't have a government guarantee, that have a lot of these consumer loans as a higher percentage of their balance sheet than, say, a JP Morgan or a Citibank. And the Fed's discount window is not set up to accept assets that are essentially worth zero, right? If somebody loses 10% of the workforce loses their job, they're not going to be able to service these debts. It's not it's a liquidity issue. This is a solvency issue for the people who borrowed this money. But we're not there yet. But I think it's going to come faster than people think, because if you look at the progress in terms of these agentic AI models and what they can do, it's insanely exponential. This isn't like China entering the WTO. If you want to offshore a factory, it takes multiple years to do that before you get to the management approval, are able to construct something new, all the things you have to do. But if $20 a month Claude bot, or however much it costs, can replace a whole team of back office counting, that's instant, especially in the United States, where you have an at-will employment market and there's really very little labor protection for people. There are going to be more companies like Block who fire a large swath of their workforce, and they're rewarded by the markets. The stock pumped 20% when he announced that. So the CEOs and management get richer if they fire all their workers and replace them from AI. That's the message from management. And we know management only cares about their compensation. And so they're going to do more of this. And then there'll be this moment where everyone recognizes, oh shit, these reports, yes, they were directionally correct, but unemployment went from 4% to 8%. And then some people start freaking out, and that's when you get the repricing of a lot of these debt instruments down to an assumed value of zero, and how you get a banking crisis.
At the same time, these structural changes are developing in the labor market. Geopolitical tensions are also increasing. History shows that conflicts in strategically important regions often create financial instability. Energy markets react, supply chains become uncertain, and global markets begin reassessing risk. Arthur Hayes examined previous U.S. conflicts in the Middle East and noticed a consistent financial response.
Let's just chart that and see, what did the Fed do? And so I put a chart in my essay, and I delineated between military strikes, a bunch of missiles fired, or like an all-out war. Again, it's not an exhaustive list. It's illustrative of the theme. And there's three main episodes in terms of a big war. And now I guess we could call this one the fourth, that stand out and mention. Gulf War in 1990, and coming out of the recession from the savings and loan crisis, George H.W. Bush, president at the time, decided that he wanted to go to war with Saddam Hussein, and essentially oil price spiked. A few months into the conflict, the Fed started cutting rates, citing the uncertainty in the Middle East as one of the proximate causes for why they were increasing liquidity in the financial markets. We fast forward to the September 11th attacks in the US and the subsequent wars in Iraq and Afghanistan, launched by his son, W. Bush. And again, immediately after September 11th, and then continuing on, Alan Greenspan lowered rates and was buying securities to essentially boost confidence, make sure that the financial markets had enough liquidity to continue to rally. And then, the third sort of major war effort was Obama's surge, adding troops into the Afghanistan war, his drone warfare in Yemen and Syria. And essentially, the Fed was already at zero in printing money at that point, so there wasn't really much more that they could do to support his efforts.
Wars require enormous resources, and governments typically finance those costs through borrowing. As debt issuance rises, maintaining stability in financial markets becomes increasingly important. Central banks often step in to ensure liquidity continues flowing through the system.
at this stage, at least going by the rhetoric and the change in tone from Trump and Hegseth, the Department of War chief. And so the longer this goes, and I think the next Fed meeting is in middle of March, the more likely it is that the Fed is going to have to respond with printed money because, people start selling equities, oil prices spike. If Trump decides he wants to send ground troops into Iran for whatever reason, whatever objective he claims he's going to give those troops, that's going to require a lot of money and a lot of borrowing. And so the Fed will have to finance the government. That is their job. And there is bipartisan support. If you look at this chart, there's been Republican presidents and Democratic presidents. Every single one of them has done the same thing. They've attacked the Middle East. And so the Fed will not have this issue of, I hate Trump, therefore I'm not going to print the money that he needs. They are part and parcel of the American empire, and therefore they will do what's necessary, print the money so that the government can spend it to, finance this war. And so that's sort of my continuum. So I don't know what's going to happen. All I said, okay, the longer this goes on, the more likely it is that the Fed prints. If we get to middle of March and, maybe there's American soldiers in Iran, or Iran is continuing to take out energy infrastructure around the region, confidence in this highly leveraged Western financial system collapses because they're like, if I can't even count on the United States to have the ability to completely obliterate Iran's ability to disrupt crucial trade and energy flows, do I really want to own these assets? Maybe I should be, holding cash, gold, or something else. So the only way you're going to get the market to come back to its senses, per se, is to print some money. And so that's how I'm viewing this. Right. Am I buying anything right now? No. I'm in my position. I'm happy. It is what it is. Yeah. I'm waiting for that press conference from Jerome Powell saying, due to unforeseen events in the Middle East, we are providing accommodative monetary policy, and whatever euphemistic term they want to use for why they're financing the war effort on behalf of Trump.
For now, markets appear to assume geopolitical tensions will remain limited. But if energy infrastructure or shipping routes were disrupted, financial expectations could shift rapidly. Investors would begin reassessing government debt, commodity prices, and broader market risk all at once.
So I think we're still in that honeymoon period of the markets. If this is next week and refineries around the Persian Gulf are getting bombed, ships' insurance to travel into the Strait of Hormuz, maybe in the Red Sea, has skyrocketed to premiums where people say, I don't even want to be there. If the airports are still closed in Dubai and Abu Dhabi and Qatar and all these sort of Middle Eastern financial hubs, then I think that the realization that this could be a long, drawn-out conflict with an unclear objective, similar to Iraq and Afghanistan, then people are going, okay, well, I know that they're, number one, they have to borrow a lot of money because Iraq and Afghanistan over 2 decades cost almost $10 trillion, right? So why do I want to own this 10-year bond? So at 380 or whatever it is on the 10-year, maybe I shouldn't be owning these bonds because they're going to have to issue a lot of debt. And do I really want to own all of these leveraged assets to energy prices effectively if this 20% of the world's energy has been disrupted and there's no end in sight for when that's going to change? And even if it stopped today, well, how do you rebuild this stuff immediately? It takes time to rebuild these things. Do the energy companies want to reinvest in a region where they just saw that a bunch of $10,000 drones took out their multi-billion-dollar facility? Do I really want to go and underwrite that again? Or am I going to have to get a handout from the government to do it again? Am I going to tell Trump, okay, you want me to build a refinery? Absolutely. Give me the money to do it.
When financial stress reaches a certain point, the response from central banks has historically followed a familiar pattern. Liquidity enters the system. According to Hayes, the signal to watch may come from the Federal Reserve itself.
So the only way you're going to get the market to come back to its senses, per se, is to print some money. And so that's how I'm viewing this. Am I buying anything right now? No. I'm in my position. I'm happy. It is what it is. Yeah. I'm waiting for that press conference from Jerome Powell saying, due to unforeseen events in the Middle East, we are providing accommodative monetary policy, and whatever euphemistic term they want to use for why they're financing the war effort on behalf of Trump.
The pattern is not new. When systems built on debt begin to strain, the response has historically been the same. Liquidity expands, central banks step in, markets stabilize, at least temporarily, but every cycle leaves something behind. more debt, more leverage, and a financial system that becomes increasingly sensitive to the next shock. Artificial intelligence may disrupt income. Geopolitical conflict may pressure energy markets. Banks may face stress from loans that suddenly stop performing. And when those forces converge, the response may once again come from the same place, the expansion of liquidity. Throughout the last decade, one asset has consistently reacted first when that shift begins. Not bonds, not equities, but Bitcoin. Because Bitcoin doesn't wait for press conferences or policy statements. It reacts to liquidity itself. So if the signals Arthur Hayes is pointing to begin unfolding, the real question becomes, is Bitcoin predicting the next financial shift, or simply revealing it before everyone else sees it? Please, let's have your thoughts in the comments below. Share this video and hit the like button. Thanks for watching. Please don't forget to like and subscribe.